Hello, Maverick Traders. It is so good to see you. We are in the first monthly options expiration week in January 2023. Let's get into it. My name is Rob Reinhold. I'm joined by Darren Fisher, and we had a really good week in the market. We'd finally broken out of some key resistance levels. So let's take a look at what happened last week. We finally got that breakout, and that happened last Friday. So we've been trading between 3,800 and 3,880 on the S&P. And on last Friday, we closed at like 38.90, 38.95. And we said, hey, if we get one more green candle on Monday, this thing is going to make a run. And sure enough, it ran. We ran nicely this week, and we ran all the way up to our 200-day moving average and our upper trend line. We saw the real bulk of this rally was international. The international markets went up much more than the U.S., and it really pulled the U.S. up. We saw China up about 10%, even though they're in the middle of a big surge. We saw materials up anywhere from 5 to 10%. Things were just really, really strong this week. The one big news announcement that we were waiting for was the CPI on Thursday. So let's take a look at what that report said. That report said that the headline number was negative 0.1%. Now that was as expected. That was the expected thing. And then we got the core at plus 0.3. This to me was a real mixed number. So the bulls got to cheer the headline number, saying, oh my gosh, look, the headline number is negative. However, the headline number has lots of volatile things like food and energy, and those things have all come down. But things like rent, wages, they've all stayed really persistently high. And the core CPI showed exactly that we're still above where the Fed wants to be. Remember, the Fed wants to be at 2% a year. This is closer to 3.5%, 4% a year on the core CPI. I thought that this was a very mixed report. And I was actually a little surprised that the market was as bullish as it was after this report. Darren, what did you think about this inflation report?
I agree the numbers were mixed, but you look at the forecasts and the actual. I think there was a lot of cheering that there were no surprises. That's what I think really drove Thursday's action, is that, hey, this came in as expected. Nobody needs to be surprised. We were expecting a mixed bag anyway. And, that's what they got. I think they were just happy that, finally their analysts, their economists called it right on. And they're starting to get faith back in there. There was no disparities between what the economists expected and what the numbers actually were. So they're like, okay, we can begin to trust the experts again. And I think that's for a lot of it. I think it was entirely psychological.
I totally agree with you, because the market was in a good mood already. We'd already broken out and we're running. And then we got the report to where it's like when you're at a party and you're a little worried that, parents are going to show up and shut it down or something, and then they don't. Not that the party got any better. It just, you had these expectations it was going to be bad, and all of a sudden, those expectations went away. So I'm with you. I think the market was in a good mood. They wanted to take it as good news, and that's exactly what they did. So let's take a look at the actual performance last week and all of the charts. So we take a look at the markets individually. The Dow up 2%, S&P up 2.6%, the NASDAQ up 4.5%, and take a look at the Russell, 5.3%. Just really big moves, especially in the most beaten down parts of the market. Oil had an 8% rally, but don't be all that impressed by that, because it literally just gained back what it lost last week. Oil had a bad week last week, so we're basically unchanged after 2 weeks. Gold was up 2.8%. That's a really big weekly move in gold. And that was the call we made, was that materials were likely going to be the best performers. We talked about that last week in our trading room. We really liked where they were setting up for this last week. But we also made the call in our year in review that we think materials are going to be one of the strongest sectors all year long. And they absolutely performed this last week. Let's take a look at the charts. Now, I put in this upper trend line, and this upper trend line basically follows a 200-day moving average as well. We don't have the 200-day on here, but no, it's somewhere around here. This line goes all the way back to January. So we only have back to August, but there's a couple points in here. Every time it gets up to this line, the market hits its head and falls down, and it continues in a bear market. As you can see here, we did not make a new lower low here, and here we are knocking on this door. Friday's candle, if you take a look at Friday's candle, we gapped down and we ran all day and closed at our high. That is telling me that this market still has lots of buyers. Here we are. We're right at this point. We had this major resistance point where every time it gets up to this point, we get a big fat red candle and a fall. This time, it's got a lot of momentum going at it. And this time, to me, it's looking like it wants to break out here. We have no idea what's going to happen next week. But just from the look of the momentum here, I think we break out and go higher. What do you think, Darren?
Yeah, if we do, I think it's a slow grind up. We've expended a lot of energy this week. I mean, you can just see the candles. It was a very, very good move. The question is, where does it go from there? I mean, you've got a lot of overhead resistance at that 408 level. And I think, this could be one of those things where you grind up to there, and then the market's got to make another decision in fairly short order. Do we continue to go, or are we tapped out right now? And you and I were talking before, and we talked, there's money flowing in. Okay, you've got a lot of January money coming in. You still got continually money coming in from 401ks. You're about to get even more coming in from yearly contributions to IRAs, and the money's got to go somewhere. So if you're a fund manager, how can you play that? Either you go in wholeheartedly because you can only be so much cash in your portfolio, or you try to slow play it. I get the feeling I think they're going to slow play it, but it's still going to be some buying pressure. Just where does it go? Where does it go to? One thing that's got me a little bit concerned is the VIX. And, the reason I'm concerned is we are at, I'm not going to say historical, but we are at complacency that we've probably at a year low in complacency. Now, when the markets get that complacent, then if we had a longer chart and could superimpose it with the downtrends that we've seen, you'd see them, they correlate very, very, very nicely. On the flip side of that, and I know I'm talking out of both sides of my mouth, that's just, the danger of being a trader. When you're in a bull market, you will see a low VIX for a very, 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 very long time. It's just, you're going to have a baseline of people that are going to be slightly hedged, but that's also one of the characteristics of a bull market is a very low VIX. So we're really at these inflection points right here, and like I said, slow grind up is what I'm looking for the next week or two.
And Darren, I'll agree with you on that. I'm really bullish here. I was really bullish at the start of last week, and I'm the same here. I do think we push through these inflection points. Here's the problem. This is not the kind of economy where you get a rip-roaring bull market. So at the moment, I'm bullish. I think we're going to push through these levels, and I think you're right. I think we push our way up to 4080, 4100 on the S&P, somewhere up in here. But the question is, are we in this economic backdrop where, again, joblessness is probably going to go higher, corporate earnings are probably going to go lower, things are in the things are in the process of weakening. Can we start a new bull market here? And I don't think we can. That being said, in the short term, I'm very bullish here at the moment, and the VIX is showing that there's a lot of people that agree with Darren and I that we're probably going to go higher, and they have no need to go out and buy puts to ensure their portfolios. They're very bullish. So let's take a look at this week coming up. As Darren said, this is an inflection point. We are right at resistance points. We both think we grind through them and move higher. We have been wrong before, and this won't be the first or the last time if it doesn't happen. But if we, let's say next week, we hit up against these levels, and then we get some really nasty red candles off them, Next week, Darren and I are going to have to reevaluate where we stand and what we look at, and we might actually downgrade our opinion of where the markets are likely to go. That's where we are right now. If you talk to us next week and we've moved through these levels, then you're going to hear a little bit different. Say, okay, you know what? We're probably going to move up to these levels. So just understand that where we are, if we did get some news over the weekend that was bad news, we could totally hit our head on this upper trend line at 200-day and go back down into a downtrend. Next week, the markets are closed Monday, so we're only going to get 4 days of trading. And fourth quarter earnings officially start. They actually started on Friday. And if you take a look at the banks, we had JP Morgan announce earnings. They gapped down and ran all day long. We had Wells Fargo gap down, ran all day long. We had Citigroup gap down and almost ran all day long. Initially, it was bad news, and there was so much money coming into this market, they just bought it up anyway. Let's take a look at the calendar next week. And I really only see one thing that is going to move the markets here, and that is the PPI. We got this CPI, which is the one that people care about. We're going to get the PPI. We've had this before where the CPI looked tame and then the PPI came out and the market said, ooh, maybe we don't like that as much. Now look at these numbers. Negative 0.5%, 1% on the core. These are looking much, much more friendly to the market. And so even if, like, let's say that the core PPI comes out at, or headline number comes out at plus 0.1, guess what? The market is still happy with that. It's still happy. Remember, we are getting these wild numbers, plus 0.7, plus 0.1. I mean, or 1.0. We got some big numbers that used to scare the market. We could be a little bit hotter and no one's going to care about this. Another reason why I think we're likely just going to continue to chew higher, because I don't see anything on the economic calendar that's going to stop us. And the only thing that I can see is maybe corporate earnings, but corporate earnings have been bought. We just saw that on Friday, that they gapped down and people came in and bought them anyway. I'm going to give this market a solid 1.5, a plus 1.5. Now look, technically speaking, it says I should be at a 2, but I can't ignore the fact that we have not broken out of that upper trend line. We have not clearly broken out of our 200-day moving average. Once we can get above that, I'll be happy to move to a plus 2. But until then, I'm at like a plus 1.5 and a plus 1 on the week. Anything to add to that scoring system, Darren, before we move into sectors?
No, I think we've got it right there. I mean, we're both talking. It's going to be that slow churn up. I mean, for the weekly outlook at a plus 1. And yeah, I mean, once we can clear that trend line, once we can clear that 200, we can do it. We're just being slightly cautious, but still paying attention to the technicals. I think that's the best way to put it. So the sectors are also playing some interesting games right now. And we can see a consumer, which had been being beaten down, up at almost 6%. I mean, they had a really nice rebound that we're going to see on the charts here pretty soon. And you've got, communication services, that's putting into, nice bull market territory. Real estate, a nice little recovery right there. Tech and materials. Tech had more of a recovery. Materials just keeps adding to the gains. Healthcare was essentially flat at, negative, 0.2% right there, which is, a little bit kind of surprising. But I want to go into the individual sectors themselves. So you can see we had a 0 on utilities last week, got a 0 on utilities this week. It's not attracting new money, but nobody wants to sell it. The dividends, seem to be pretty attractive to people right now in utilities, so they're just going to keep it. I think this is going to stay. I mean, I think you could run a butterfly on the entire utilities sector for the next month and still be looking pretty good. Don't even have to pick individual names. Communication services, plus 1 last week. We're now at a plus 2. Okay. The reason I'm at a plus 2, it broke through that resistance that we had a couple of months ago. It just barely did it today. That's fine. I'm willing to cut this guy a break and say, okay, yeah, you can go to plus 2 right now. Now all we need to do is start to see those moving averages tilt upward again, get that 20 above the 50 right there, and then I think that gives a lot of people a lot more confidence to continue to see, start picking and choosing good names in communication services that they can go for. So that's some upward movement right there in comp services. Real estate was at a zero last week. I give this one a solid +1. The reason I'm not going to go with a +2 just because we only had, we're right at that resistance level right there. And we had a little bit of a down day on Friday. Now, that's fine. We'll just see where it is. The question is, are we range bound or, between that 30, call it the 36 level and the 40 level, or do we break through? That's the things we're looking at right now. Technically, though, I got to go with the +1 in real estate. Now, industrials. Here's another one. And we're going to see this in a lot of the stuff that's +2. We're right there at resistance again. Industrials has been one of the best sectors. We've been really liking it. There's a lot of good names in there. The question is, can they as a whole, as a sector, break through that resistance and move on? And, I think it depends on how the portfolio managers are looking at it. Are they investing from the top down, or are they investing from the bottom up? If they're investing from the top down, then they're looking at the broad markets, seeing that they're above the 20, they're above the 50, and they're going to put capital to work in, I don't want to say indiscriminately, but broadly. If they're looking at things from the bottom up, then they're going to see some of these sectors are right at resistance. They're going to be hesitant to put additional money into them because their upside they feel is limited, and that's going to make them look for other places, and it might stall things right there. So there's about 4 sectors that this is the case for, that we're going to go take a look here. They're all right at resistance, but they're both above the 20 and the 50, and have generally been performing fairly well. Looking at industrials, it's not industrials, excuse me. Looking at healthcare, we were 0 last week. I'm still at 0 this week. Just not a whole lot going on. Kind of like what it was with utilities. This, I think, has achieved a nice little range. I wouldn't make the broad call and say that you could go out and put a butterfly on the entire healthcare sector for the next month. This is one that I think is probably going to break one way or the other pretty soon. Just that range right there is narrower, and I think we're going to be looking at some earnings coming up right now, and that's going to drive a lot of things. So we'll see which way we go from this base, but right now I'm at a nice comfortable 0 right there. Financials, I'm at a +2 in financials. And this is another one that is right there. You can see we've got overhead resistance right there. And it's the same thing. You as a money manager, what's your risk reward? What's your risk? Is your risk that we turn over and fall down? You're not going to put new money into it. Is your reward that we break through and go on to make new highs, that we can clear that overhead resistance? You're going to put new money into there. This is another one that we've taken a look at, and is giving a lot of things. Which way are the fund managers looking at things? Looking at consumer, had some improvement in consumer. We were at a -1 last week. I'm at a 0 right now. We're right at that 50. We did close nearly at our highs today, and it was a nice looking candle right there. But the last 3 days, you can see we're just kind of hovering right there at the 50. That's always been our line in the sand. We're firmly above the 50 period moving average, we're bullish. If we're below the 50 period moving average, we're bearish. When you're right on there, I think you just have to go with a 0 and wait to see which way it goes. And you've got a lot more resistance much further up. About that 145 level is where the resistance is on the consumer sector. That's a little bit of a ways to go. That's a little bit of a overhead supply to nibble through and get there to be much more bullish. So you've got some no man's land right there that you've got to slog your way through before you can truly say, okay, consumer is now again a nice bullish sector to be in. Looking at tech, that was another one that was a -1 last week, and we're at a 0 again. Basically the same story as consumer. You've got that resistance up there at about 135. Had some good days, but you're still the last 3 days sitting right there at the 50 period moving average. You've got that no man's land ahead of you. Which way do we go? Okay, I can't make a bearish case for either consumer or tech, but this is going to be one of those ones where if it does turn into a bullish case, it's going to be an ugly journey to get there. On to materials. This is another one, +2, but we're right at resistance. I mean, this is one of those annoying things. I mean, you've got 4 sectors here that we've all got +2 that are all right near resistance right there. Where does it go? Do you push through, or do you wait, or do you turn around? And that's what I think the next 2 weeks in the market are going to determine. If we can get movement in these 4 sectors that have been outperforming, then I think these 4 sectors pull the rest ahead of them. But if they stall, I think that does stall the broad markets from moving forward as well. Energy, we were to 0 last week. Yeah, I'm in a good +1 right here. It was in a nice little range, right there between about the 83 level and the 88 level. I think we broke through right there. So mildly bullish on energy right there. And we did call energy to be one of the weakest sectors for the entire market here in 2023. And we'll wait to see where it goes. Now, when we started off a couple of weeks ago, we said everything looks like a horse race right at the post, and the gun's gone off, and the horses aren't going anywhere, and the jockeys don't know what to do. Okay, we're starting to see some movement in which horses are good. You can see materials, financials, industrials, communication services. They've actually started to run, and they're looking pretty good. Energy and real estate, they're kind of at their trot, but 4 sectors: consumer, healthcare, tech, and utilities are kind of still at the post. Don't really know what to do. So we're going to wait to see, are they actually going to begin moving forward? So taking a look at a couple of picks. So last week we were long VTR, and this had a pretty good week. It was up 2.45%. It cleared out of that high base that we were in, looking pretty good. I think we've got another week on this trade. It looks to be doing pretty decent. This week we're looking at DLR, Digital Realty. I'm going to go sideways to slightly bullish right here. It's been in this range, but it looks like it's going up to the middle, the top of the range right now. So we're going to say, with center point, some sort of butterfly with center point about 110. You can go to 105, 110, 115. You want a little more room to play. You can do the 100, 110, 120. Whatever you want to do, as long as you got that 110 as the center point, I think that's the place that you want to be for something like this. If you are more bullish on this sector right here, go ahead and go out and do the February 105s and short this next week's 110 against it, make it into a diagonal call. But I'd honestly be looking at a butterfly with a 110 center point to be doing this. In communication services, last week we were long Meta, essentially Facebook. I still don't know why they changed the name. But it broke out and kept running. You can see we've got 4 green candles this last week. Pretty good. It was up 5.35%. So this trade's looking really good as well. We're quite happy with it. This week we're looking at AT&T, nice high base, and we're looking generally. You don't see us trade a lot of stuff. AT&T, you look at the scaling on this thing. You got 50-cent scaling on the sides. We're not looking for $5 moves right here. So we're looking at something. You want to stay in that high base. I would probably go out and be looking at the February 3rd 1850s and short this next Friday's 1950s against it. So we're really looking at we're not looking at any hero trades in AT&T. We just think it's gonna stay out there. Right about where it is. And healthcare, last week we were short TDOC, and this is one of those ones where it gets beaten down so much. Eventually, someone comes in and hits a bid. TDOC was up 20% this week. If you got into this trade, just write it off. We've got so many other trades that are working for us. This is just gonna be one of those ones that go into a bucket as a loss, and come last week of December of 2023, you're not even going to remember that you made this trade. This week, we're looking at Eli Lilly sideways. And sideways looks to be pretty good. It's in this nice high base. Several different things you can do. 360 be about your center point right there. And you go at 350, 360, 370. It's probably pretty good where you want to be. If you want a little further out, give yourself another week to do 345, 360, 375. I'm probably just going to go out for a 1 week though on this one.
Moving on to the industrials. Industrials was my second favorite sector last week, and last week we talked about Raytheon, and Raytheon got hit pretty good on Monday and never really got back on track. So the stock was down about 3% for the week. We had a diagonal call spread on it, so a small loss on that. As Darren said, we've got so many others working for us. You take the loss, those losses, and move on and redeploy your capital elsewhere. So let's talk about elsewhere. We've got Otis Worldwide. This used to be called Otis Elevator. And you can see it's breaking out nicely. So we had this move up. We hit a little base here. We ran out of it. We pulled back. We came up, spent about 5 days trying to get through it, and then we punched through it. Now, a lot of times when you get this kind of move, where we went from 78 all the way up to 82, you could see it ran out of gas a little bit, but the market was so strong, it pulled it up. This is where you can't expect it to have a ton of energy because the last run started at 78. So this is where you say, okay, we think 85 is probably a possibility for this. So this is where we want to set up our trades to say, hey, you know what? Let's not ask for this thing to go run up to 90 or 100. Let's be very, very reasonable on this trade. I like the diagonal call spread here. So it's going to be the February 80s. So this Friday is 85. It's just going to be a nice, slow-moving trade. If it moves up $2, guess what? You're going to have a nice full profit gain on your hand there. Financials is a sector that has surprised me with how good it's been. Last week in financials, we did AIG and we did a diagonal call spread. Now, this was a perfect setup for a diagonal call spread because we basically are making this at the money. So we had it at 65. So 65 was our max gain point. If it closed at 65, that would have been perfect. We closed a fraction below that here at 64.41. Now, the thing I love about diagonal call spreads is, remember, you're long a longer dated option and short a short dated option. Well, if that option expired on Friday, you now just have a long call. And I love when you have a long call when you just get this really nice bullish engulfing candle that looks like it potentially could make a nice run. So I like this trade. I think it still looks good. The whole sector looks good. This week, let's take a look at this one. STT, State Street Bank. This is a mid-sized bank here in the U.S. And overall, this thing had its nice run off the bottom. We had a little bit of a base here, and you can see we're starting to break out from the top of it. So we've built up some energy. We coiled. I think this thing is going to be let out. However, this is a low volatility stock. This isn't a stock like Netflix or Amazon that when it breaks out of a range, it can run 10, 20, 30%. This thing can run $3, $2. So let's be reasonable on it and take a look at some reasonable trades. I like this one here, the 80-85 diagonal call spread. That's going to give you a little bit of upside. And because it's a diagonal call spread, you're going to have a little bit of positive delta and you're going to get a little bit of positive theta. So if it doesn't go anywhere and it doesn't fall, you make money. If it goes somewhere, you make money. If it falls too much, that's when you lose. And this one looks really good for that kind of trade.
Yeah, last week in consumer, we were sideways on Kroger right here. And this looked pretty good. We're still right in that range. It was down 1.14%. I mean, this is still a really good trade that you're looking at right here. I think we've got about another week left on this one. I think this expires next Friday. So as long as it hangs out here in this one, I'm happy to stay sideways in this one. Now, if you're right at that 45, if you see it go through the 45 right there, and you want to cut the position here, Monday, Tuesday, Wednesday, that's completely fine as well. You can always end your butterflies early. There's nothing wrong with that, especially if they happen to be targeted. This week, we're looking at Kellogg's. We're going to be sideways to slightly bearish. And you can see we're in a range, but it looks like there's not a lot of faith in Kellogg right here. I mean, you've got the range, all the way down from 70 to 74. I mean, you've got even a little bit more down there at about the 60. A little bit more down there about the 68 level. So, I mean, how do we want to play this? This is pretty slow moving as well. I'm probably going to say this next Friday, 67.50, 70, 72.50. called butterfly. I think that's the way that that's a good way to play it right there. We bounce off right here. I think that's good. I would wait one day to make sure that we're not going to totally fall apart right here, which I don't think Kellogg's is going to fall apart. But it's something with a midpoint of 70, and you hold it for a week. I think you get paid out fairly well. Technology. Last week we were long Flex, and this one had a really good week. The Flex was up, let's see, 7.9%. So this one's looking really good. If you've got more time on the trade, I'd be more than happy to stay at it. You see that bullish engulfing on Friday right there. I mean, just a really good. We gapped down a tiny bit, and then it was just let's see how many people want to buy this. So Flex is looking pretty good right now. Really happy to have that. Now this week we're along that. We're gonna do a kind of a pairs trade. This week we're gonna go a short position in CrowdStrike. This is a really low base right here. If you zoom in, you might even be able to call this a slight bear rally right here. Right sitting there at about 100. So I waiting for a confirmation candle. Make sure this doesn't try to break up above 100. But I think give it a 3-day 97 100 bear call spread, and I think that's definitely the way to play it like that. So this is looking pretty good to the downside.
And Darren, I'm glad that you brought a bearish trade in here because they were very hard to find right now. And the last thing we want to do is get too far out over our skis because at any time we could be wrong and we could get bad news. So it's always nice to have some other trades working on the bearish side. Now look, just like our Teladoc trade, our bear call spread, okay, it was a loser, probably max loss at this point. But we always need to have those working because what if we do hit that point and the market does reverse? If we're 100% long, that's going to be too big of a drawdown. If we're 70% long, 30% short, we can manage these points. So I'm really glad that you shared a short here with everybody. Let's move on to materials. This is my favorite sector at the moment. It's my favorite sector for the year. Now look, I say that, but I am a short-term trader. I can change my mind and I could hate this thing next week. But for right now, look at this breakout. We talked about this Dow, DOW. We talked about DuPont. We've been sharing with you a lot about these chemical companies and the mining companies. They're all looking great. Look at this run. So we got long last week, and Dow was up almost 7% for the week. And it still looks good. I mean, take a look at these big candles. And on Friday, it gapped down, and people are still buying. Obviously, at some point, this is going to run out. But for the moment, there's a lot of momentum here. I'd say stick around until you get a red candle and then bail and take your profits and move it on to the next one. Speaking of the next one, this is AEM, Agnico Eagle Mines. And this is a gold miner. And gold has been doing really well. And you can see we've got this nice little base here. That's what this thing's doing. It's just moving up and basing. And then it moves out of the base and then bases again. Big question is, when do we get that next move higher? We don't know when, so that's why we have to use trades that are going to give us time. Looking all the way out to February. So we like this on an uptrend. We think it's going to continue on an uptrend. However, we don't know when it's going to break out and run. Just give yourself some time. Give yourself 4 weeks, 5 weeks actually at this point. 5 weeks of time, plenty of time to let this thing drift up into that area. So we just like the straight vertical bull call spread here. And energy, Darren, you gave it a +1. I agree with that. Last week we had Chevron sideways, and Chevron basically went sideways. It was up less than 1%, up 0.5%. Really nice trade. We got this 180 as the butterfly. So we do want this to work its way up a little bit more. 180 would be the perfect close for this trade at the end of next week. This week we're going to stay with that sideways theme, and we're going to take a look at PSX, Phillips 66. Now I'm going to be slightly bearish. So last week we had oil down, energy moved down a little bit. This week we had energy up, oil up, energy was up just a fraction. I think we're probably going to be in this seesaw back and forth. So I'm going to do a slightly bearish, looking out for 2 weeks. So the stock right now is at 103. I'm saying I think it goes down to the 100 area. That's what I'm saying. This is not a big call directionally. This is a call sideways. And you can see if we just hang out in this area, a little bit of weakness, that's going to be a really nice butterfly trade here on PSX. That wraps up our trades we want to share with you. If you want to jump onto our website, Maverick Traders, log into the members area, get onto the blog. Let's start sharing trades with all of the other traders at Maverick and help us all make some money. Let's go ahead and wrap this up. We've got markets at major resistance levels. I think we break through. That's just what the market is showing. We've got all the signs that it's going to keep churning higher. Here's the problem. It's very hard to make the case for a new bull market that lasts 6 months, where we get higher highs and higher lows, just like we had in 2021. We're just not in that part of the economy right now. We're not in that cycle. Any upward movement is likely to be smaller and not last as long. Until this economy really turns around and starts growing again, we probably don't see another bull market. But at the moment, that's where we are. We're bullish. We're bullish for the moment. We'll make some changes when the market changes. But right now, I wouldn't tell anyone in my own personal life, hey, this is the bottom of the bear market and it's time to buy. I am not telling that to my friends and family. I'm telling them, hey, you know what? We probably still have a little bit more before we can get out of this until the economy turns around. So I just want to kind of bring that up to help people understand where we are in the cycle and our mentality. The market's bullish right here, right now. If you're a trader and you're looking to trade over the next couple weeks, couple days, couple months, you probably need to be more bullish than bearish. So be short-term bullish for the moment. Look, if you are bearish, if you're pessimistic about the economy, if you're pessimistic about the direction of the country or whatever, that's fine. Just be bullish for right now. And then when it turns around and goes back down, then you can say, see, I was right. But guess what? You made money on the way up. And you didn't lose money trying to fight it. You made money. And then it went down. And you said, oh, that fits my bias now. And look how happy you were. You made money on both sides. So trade the market in front of you. That's what we say at Maverick all the time. Not the market you want it to be, not the market you think it should be, but the market that is. The market that is bullish at the moment. That's all I've got for you. Thanks for joining us. Everyone have a great weekend. Goodbye, everybody.
Good trading, everyone.